Okay, we're recording.
Awesome. I love it.
All right, Karl, to everybody who's watching, this is Karl Farasyn. He is a loan officer, and I'll let him introduce himself. But we felt like it was super important to do this and get it out quickly so that everyone has the right information to make the best decisions. We chose getting the information out over production quality. So we're kind of shooting from the hip here. And if there's technical difficulties, you're just going to have to deal with it. But Karl, who are you?
My name is Karl Farasyn. I am a loan officer with Luminate Home Loans, which is right here in Minneapolis.
Very cool. Anything else people should know about you other than that you got rid of your wonderful mustache?
It's still kind of there.
It's there a little bit.
I have been in the mortgage industry for 7 years now. So kind of seen the ups and downs in the market and more experience this year. So far, year to date, has just been unlike anything that I've seen. And I think, some of the loan officers in my office have been doing this for 20, 30 years and unlike anything that they've seen. So it's kind of fun to hop on here and talk about it and get the right information out to people that are looking to buy.
Yeah, what's really interesting when you say that is I got into the business 9 years ago, so we're kind of similar. You're 7, right? I'm 9.
Yep.
And we haven't really seen like a terrible down cycle ever. I would say it was a little slower when we both first started, but
Yep.
What's interesting is I think your loan officers that are in your offices who have been doing this for 20 plus years are saying the same things that real estate agents in my office who have been doing this for the same amount of time are saying.
Right.
And that is that this is one of the most challenging times in markets that they've ever been a part of.
Yep.
Even more than some of the down markets, which is, it's just so interesting to me because to the general public, they think we're shooting fish in a barrel.
Right. And
Right.
That's not the case.
It's crazy. So anyways, the purpose of this conversation is to address the kind of the narrative and the rhetoric around interest rates. Yep. Because everybody knows that 60 days ago, actually, was it 60 days, 90 days when we were still in the threes?
That was probably January, February timeframe that it was still in the threes. After that, it kind of broke out to the fours. Didn't really stay in the fours for very long. Jumped up to the fives, and now we're seeing sixes.
That's what I was gonna say. It almost seems like it skipped 4.
Yeah,
it went from
didn't really last in the fours.
It went from high threes to all of a sudden it was like, hey, rates are 5+ now.
Yep. So it didn't last in the fours for probably more than a month.
Yeah. Okay, so let's just cut right to it here. So what is we're seeing a lot of headlines.
Yep.
About a meeting that took place yesterday.
Yep. So tell me about that. That's the quarterly Fed meeting. So what that kind of is it's a meeting of the Fed. They basically kind of decide how they're going to, what their economic outlook is going to be for the next quarter, or the next month per se. So what they kind of decided yesterday is that they're going to do a 75 basis point rate hike. And what that means is the prime rate, for car loans, auto loans, installment loans, anything like that, those rates are going to go up. The Fed hiking rates doesn't necessarily correlate with mortgage rates. Mortgage rates kind of go off of, headlines, and recently more or less the inflation report. And that's kind of what drove them up, last Friday, Monday, and Tuesday of this week. And what actually happened is when the Fed announced that they were going to do a 75 basis point rate hike, is mortgage rates actually went down following that news. That's good news that they didn't do 100 basis points, which some people thought they were going to do.
So because people thought they were going to do more, but they actually did slightly less, that forced the rate down because the driving force behind mortgage rates is more of a vibe on how things are going than actual.
Correct.
That's what I'm getting. Is that right?
Yeah, that's accurate. Yes.
That's so interesting to me.
Yeah. So they not necessarily saying they went down, but they did go down from where they're at Friday, Monday, and Tuesday, because those 3 days they were more or less reacting to the news that while this inflation report was way higher than people anticipated, and people thought the Fed was going to increase rates at 100 basis points, what should end up being 75, which was kind of predicted. So mortgage rates kind of already built in that buffer to kind of react before that news came out. And when the news came out that it was only 75 basis points, kind of drove that market down a little bit.
Interesting, isn't it? Okay, perception here, because you just said only 75 and everyone else is freaking out. Like I have up on my other monitor here, I went to Google and all I typed in was interest rates, and I just wanted to see what popped up.
Yep.
And the first story that comes up is Federal Reserve raises interest rates by 0.75%, most since 1994 amid inflation. And then, some of these other ones are like, mortgage demand is now half of what it was a year ago, which is probably true, but like that headline is just scaring people.
Yep.
And I bet what no one understands is that if they were looking at locking in on Friday of last week versus locking in today, that number's actually down.
No. So the market kind of adjusted. So it went Monday. Monday. Yeah. So
we're
Friday,
probably back
Monday,
to where we were.
Tuesday
Friday
was kind of a collective 3-day run where rates.
Got it.
That was the biggest spike that we've seen in rates in a very long time.
Was that Monday?
The 3-day collective span.
Okay.
So from Friday, Monday, and Tuesday, that was the biggest 3-day span that we've seen rates increase since, I think it was like 1980, which is kind of crazy to think about. So that adjustment, when rates went back down a little bit following the Fed meeting on Wednesday, it didn't drop to where it was prior to Friday, but it came back down a little bit to kind of level it out.
Well, so, I don't think anybody expected them to go down.
Right.
But with announcing that they just took the largest increase in history, people probably assumed they went up.
Yeah.
And so we can safely say that they didn't.
Correct. Yeah. I mean, they went up overall in the last week, from Friday, Monday, and Tuesday, those gains that happened over those 3 days, but it did come back down a little bit on Wednesday following the Fed meeting, which
interesting.
Yeah. I mean, it kind of gets skewed in the market, and the news, and what everybody's reading online, like that report that you were just talking about too.
Yeah. So the Fed meets quarterly.
Yep.
I've heard a few people, loan officers and things, say that they were planning 6 meetings this year. Is that right?
Yeah, and that's due to the inflation. So there are more this year that are taking place. So they're releasing a monthly CPI, which is the inflation report.
Okay.
And that's going to be kind of the biggest indicator of what mortgage rates are going to do this year. Once that kind of levels off, I think mortgage rates will kind of taper off. And another thing to keep in mind too, Trent, is the volatility of the market. So right now, where mortgage-backed securities are and where the bond market currently sits, if it was a normal market, rates would still be, 5.625 to 5.875. But because of the volatility in the market right now, the secondary markets are building kind of a buffer that drives rates up, and it's kind of sitting right around that 6.25 to 6.5% right now. So once we kind of start seeing inflation level off, I think those mortgage rates will ultimately come down to where they're supposed to be.
Yeah. So, okay. So what inflation could impact that if inflation gets under control? Yep. If inventory increases and the market becomes more stable, say it goes to, like right now we're at, say, 1 month of inventory. Yep. Say we get to like 3 months of inventory, or even 6, right? Because a buyer's market really starts to happen right around 6 months of inventory. When that happens, does that impact rates to go down as well?
Yes. And I think it will eventually, because that's the whole, we've seen just an absolutely crazy market, like you touched on initially, these past few years, just because rates were so low. I mean, there was no inventory. You were going into multiples on basically every single offer. And once that kind of starts to flip-flop into a buyer's market, I think that will also drive rates down as well.
Interesting. All right. So if you have somebody talking to you about real estate and they're considering buying or just transacting, selling and buying in this market, but they're a little scared, what kind of advice do you give?
So typically what I, always tell clients is, we pick the program and the rate that's going to best fit them, obviously. So one thing that's making a huge comeback is adjustable rate mortgages. And what those are is, it's a 3-year fixed rate or a 5-year or a 7-year or a 10-year. And it's going to be fixed for those first, initial period, whether it be the 3, 5, 7, or 10-year period. That helps them keep their rate a little lower and helps them kind of get into a home. And typically within that time frame, people will usually refinance. I don't foresee rates staying this high forever. As we've seen in the past, it kind of goes up and down. So always, reassuring them that, hey, you can refinance down the road if rates do go down, and we're monitoring that market daily. So it's not really a forever thing. It's more or less getting somebody into a home, building that equity. You're not competing into multiples right now. Getting them into the home, building that equity, and then, refinance down the road with the equity that they built over the last couple of years.
Yeah, I think that's really great advice. I like the ARM option.
Yep.
And I always like to give people too the risks involved, so what's the worst case scenario, right? So the best case scenario is you lock in an ARM. Let's say, what's the most common? Probably a 7-year.
Yeah, 7's typically the best
so
price.
You lock in a 7 at what today?
So 7-year ARMs are, depending on obviously the situation, circumstantial.
Yep.
Typically sitting around low 5s right now.
Okay, so pretty significant savings in terms of interest over the life of the loan.
Yep.
And monthly payment. The risk, of course, would be that would it be a 7-1?
Yeah, so some of them are 7-1 where they'll adjust every year, and the max they can adjust is either a 0.5% or a full percent, and it kind of adjusts to the market at that point.
Yep.
Some of them also are 6 months where they'll adjust every 6 months, and it's the same thing. It could adjust every 0.5%, and sometimes those 6-month ARMs are actually pricing better as well.
Okay, interesting. So if how much can they increase annually after that 7-year period typically?
The max, if it's a year adjuster, the max they can adjust over a year is a 0.5%.
Okay.
So then they have a max that the rate can go. So if you're locked in at 5%, the max typically is 4%. So the max it can go up to is 9%.
Okay.
And
so you could lock in at low 5s today. In the next 7 years, if the rates for some reason don't go back down, the worst case scenario is that they actually continue to go up. And in year 8, your 5% rate goes to 6 or 5.5. Did you say
Correct.
0.5 point or 1 point?
Yeah, half point. Yep.
So then it goes to 5.5. Year 2, they go up again. It can go to 6. So even if the market rate went up 2 points, yours can only increase 0.5 point.
Correct. Yep.
So the risk actually really is not. There's not much.
As significant as it seems.
Yeah, there's not much. Could you, could somebody refinance out of an ARM back into a new ARM?
Yep, absolutely.
Do people do that?
I've done it in the past. Yes.
Interesting.
We haven't done it that much lately.
There's been no
where
need.
Rates were. The ARM product was dead for the last 3 years.
Yeah.
And now it's starting to make a comeback because
my first house was an ARM.
Really?
And it was phenomenal. I'm so glad we did it because we knew we weren't going to be there more than like a few years.
Right.
So we went and got an ARM. I think it was a 10-1, and our rate was like 2.3 or something, just insane.
Yeah. It makes crazy. A ton of sense for
we sold 2 years later. So it's like if you're going to be out, it's the best option. So
right. And a lot of these first time home buyers don't even stay in their home for the first 5 years. Even they're trying to move up when they're starting their family. So it makes sense. They're not even hitting that adjustable period.
Yeah, for sure. Cool. Well, do you have anything else to add? I feel like we can make this kind of short and sweet. And I think what people just have to take from this, or I hope they take from this, is like, understand that when you see headlines and when you see interest rates, the Fed raising interest rates, that doesn't necessarily mean that you're screwed as a buyer because your interest rate is going up.
Correct.
And the reason why I wanted to do this conversation, Karl, was like, we have to get this information out to people, because there's probably buyers out there who are like going and hiding in their caves right now.
Yep.
But they don't understand that this recent rate hike actually didn't impact things as much as they think.
Right. Yeah, I agree 100%.
Cool. So let's wrap this up with, where are rates going to go in the next 6 months? What's your crystal ball tell you?
Wow, that is a loaded question.
Right? Do you remember like 3 years ago when we were like, rates are never going to go down? And then they went down.
Then they bottomed out.
Yeah. And then I also remember not long before that, we were like, it's going to hit 5 soon. And that was when it dipped down to like back to 3.
Yeah.
Oh, it's just crazy.
Yeah.
Where are they going? Yeah. Where do you think they're going?
Personally, I think it's going to be like a 6-month thing. And then they're going to start to kind of trickle down. I'm not saying it's going to be a huge drop where we're back in the 3s in a month or so. But I say 6 months, I think they'll go back down towards where they need to be once the inflation starts to correct itself.
Yeah, it seems like the only thing too that's going to really balance out the real estate market is if those rates do stay up for a little bit, because we need inventory, and the only way we're going to catch up is if people slow down.
Yep.
So it's kind of like I just see like, the government is just sitting there with this little like volume knob.
Yep. That's exactly what they're doing.
And they're just going, let's turn it up a little bit more. Okay. No one's doing anything.
Yep.
Okay, let's turn it down a little bit.
That's exactly
just to get a few more people in. So cool. All right. Well, thank you so much. And to anybody who's watching this, if you got value out of this, throw a comment down below. Or if there's questions you have, let us know, and we can continue to do things like this. And I hope if you watch this, you take something useful. And Karl, what's the best way for somebody to get a hold of you?
Phone call, text, email. Trent will post my info somewhere in the subject of this video. So yeah.
Oh, I will.
Any way works.
All right. Do you have a website? KarlFarasyn.com?
I do, yes. KarlFarasyn.com.
Cool. All right. All right, everybody. Thank you so much. And Karl, thanks. We'll see you later.
Yeah, thanks for having me, Trent. Appreciate it.
Bye.
Bye.